But I called this live pop-up meeting today to be able to discuss ways you can be bearish on oil or bearish on energy. We're going to focus mostly on oil because you know it's been going up quite a bit. It was up almost $96 a barrel. When you're talking about trading the exact oil here, this is the oil for the United States, the light sweet crude oil, the /ZL. This is the most direct way you can buy or sell oil. So if you wanted to be bearish, this is the most direct way to do it. It's using the futures contract or options on futures. We're going to be talking about the options here. So you can see that the high was basically almost $96 a barrel, and a lot of people are predicting that that oil is going to hit $100 a barrel. And then if Russia evades or annexes Ukraine, and that oil could jump up to even higher. Some people are predicting $150. You guys know at the Dorian Way, I'm betting the opposite, that oil is way too high at this point, and that if it does hit $100 a barrel, we would most likely be down 40-50% in the next 6 months or so. So I want to use this live pop-up meeting to kind of go over some ways we can short oil, but do it by using leaps, because we don't know if it's going to happen right when Russia annexes Ukraine, if it's going to be something like buy the rumor, sell the news type of event, that old adage on Wall Street, or is oil going to spike up even more because of the uncertainty of what's going on with that and what other countries, NATO countries, are going to do to Russia regarding sanctions, and if that's going to kind of ratchet up all the energy fears, because a lot of this price, I believe, is associated with energy fears. It can also deal with inflation. We know inflation is running rampant across the United States, with energy prices, obviously, with housing prices, with grocery prices, for just to name a few examples. But we don't know when oil is going to go down. No one knows that, regardless of how many degrees or how long they've been trading. No one knows that. So we're going to use the leaps this afternoon to be able to see if we can kind of benefit when it goes down, but give us a little bit more time to do it. So technically, a leap option is just like any other option. Okay, it has an expiration date, it has a delta associated with it, it has time decay associated with it. Okay, and it can be something that's in the money, it can be something out of the money. What differentiates leaps from other type of options is that leaps are just longer term. So a technical leap, textbook type of leap, is anything over a year, anything over 365 days. But at the Dorian Way, we consider a leap anything over 100 days, because we normally primarily trade between 30 and 60 days. And then anything under 30 days, we consider short term. And then anything over 60 days, or at least anything over 90, so 100 days or more, we consider long term. But technically, a leap is anything over 365 or anything over a year. We trade a lot of leaps, or what we call long dated options. Ernie provides a lot of that every week regarding doing long dated or leap type of options. But we're primarily demonstrating the selling process. Today, we're going to demonstrate the buying process of leaps, okay, or long dated options. So you can see here that this is the most direct way to participate if oil goes down. You can see that it's been overbought for some time. It has had a drop. You can see right here it was overbought in this relative strength index, this RSI. It's dropped some, but I still think it's way overdone, as this chart is indicating. So if you were going to play it and you were going to do something long dated, we're going to bring it up here on this TastyWorks so we can kind of demonstrate it pretty easily. So we think anything over 100 days is long dated in the Dorian Way once again. But the textbook long dated for leaps is is 1 year, 365 days. So you can see with the futures contract, we only have 181 days for options. So what we would do is go down here and we would find the at the money line here, and we would buy something at or near the at the money line. So if we bought this 82 put and we paid almost 10 or almost $10,000 for this put, that's how much it would cost if we bought this put here, as you can see here. If you were doing the futures contract, this is a big contract. It's $1,000 a point. So that's a little expensive for most size accounts. So you can do a kind of a put spread leap, and you normally, when I do a put spread leap, I'm trying to sell or have the put spread as wide as the expected move. And right now the expected move is about 20 points, just under 20 points. This 19.28 on this futures contract here. So this will be the kind of play. So that drops that down significantly to 650 or 6,500, but that's still pretty expensive. And you can make potentially with this spread up to 13,000, as you can see here. So if you wanted to make this a cheaper play, then you can decide to bring the spread in. The more you bring the spread in, the cheaper the play is going to become, but it's still going to that's going to lower your max profit the more you bring that spread in. So I don't want to play this one, but you can decide to play something like this. This is a great one. You can decide to play it. And if you only wanted to spend like $1,000 or something like that, you can do something that is a lot less wide. But I want to play it for a little cheaper. So let's say if we went here, this would be about pay one to make one. As you can see here, pay $940 to make $1,000. So that's not bad, but this for a long dated one, for this oil, you might want to get a little bit more bang out of your buck for what could potentially happen. All right, so the next thing I want to look at is XLE. This is one of the popular ETFs, energy ETFs, and we can also go, let's see if we went out 337 days on this one, and we decided, okay, well, we're going to buy the at the money. We're going to buy the at the money put, and we're going to put it in at the mid here, which is 725. So this is not bad, right? You're paying 725. That's the max you can lose, and you can make up to almost under 5,700, just under 6,000 if it went to zero. You know, this is an ETF index. It's not going to zero. So most likely you shouldn't expect that, right? But you could expect it to go down to $50, this index, and that would be a nice little move. If it was below $50, you can make it, $1,000 or whatever the case may be in the next, 337 days here. But the way we look at it at a Dorian Way, if we're going to buy an option to try to make money, a directional type of play, we're trying to have at least a, as best we can, a 50-50 shot. And so just the back of the envelope or back of the hand type of calculation, we believe anything at or around the 50 or at around the at the money line here, this ATM is about a 50-50 shot. It's a coin flipping chance. It's technically it can be a little less than that or a little more than that, but just for simplicity purposes, we say at the money is a 50-50 shot, okay? So what we would do is get out of this once we are down 50%. We're trying to do a directional move. We know it's only a coin flipping chance of winning on this directional move. So once we're down 50% on how much we paid, then we're just going to say, okay, we were wrong on that directional move. So this is one you can play to buy just to put outright, or you can decide that you're going to buy a put spread, kind of leap put spread, and you can, this is a little bit more than pay one to make two almost here, right? So, or it is to make two here. So this is a good little play on the energy sector, betting that it's going to drop. You can see if we go here and look at this chart here, that this one has it's been just as bullish as that CL, that futures contract. All right, so the next one I want to look at is XMO. This is Exxon Mobil, and you can see that this has kind of followed the bullish pattern of the other two you know, oil or energy stocks we just looked at, right? It's been in the overbought area for a while. It's backed off it a little bit recently, but I still think once again that this is the beginning of a move. We don't know if it's going to be, you know, tomorrow, next month, or 2 months, or whatever the case may be. That's why we're trying to do leaps here to bet. Okay, this is going to happen within this time. And if we're wrong, we'll know we're wrong once we're down 50% on the amount we paid. So this is Exxon Mobil. We can go over here and let's look and see what we can do. So let's just look at 246 days here, and if we bought this at the money here, then this would be about 770. If we bought a little in the money on the put side, so this would be about just over $900 to pay for it, and then you got the potential to make a little over 7,000 if it goes to zero. Exxon is not going to zero, so most likely what you're going to be able to make within this time frame is maybe you know, maybe $1,200 or something in that nature. It could be a little bit more, but that's what you're looking at. If you did the put spread, that would be the max you can make. It just under 1,300, as you can see down here. But in this case, I would buy the put at the 80 strike and get out of it once I'm down about 450. Okay, about 50%. All right, so this is Exxon. This is a way you can play it. And then another way you can play it is USO. This is another ETF index. You can see that once again, all of these things that we're showing has been going in the same pattern. If oil goes down, all of these things are going to go down as well. And so you can decide which one you're going to play. Right? So this is USO. This is the oil kind of ETF, one of the most popular ones to play. And if we went out, let's just say in this case, we went out 337 days and we bought the basically the at the money. It's about 83 cents out of the money here. We bought this for 960. Then we can have, you know, we can have the ability to make all the way to zero. This index, once again, none of this stuff that we're looking at will go to zero, but you can get a big move if this drops. Let's say it drops 50% or whatever, what we're saying. Well, that would be a nice little play, you know, maybe about a little over $3,000 you can make on each contract you do. I'm just showing you one contract here, but if you did more. So if that 900 was too expensive and you just wanted to get the expected move, so you can do something like this, pay about 730 and be able to make 1370 for every contract if it expires below 42. But you don't want to wait until that concept, right? This can be once, you know, this can be trading around $1,000 a contract. You know, I would ring the register around that point and say, okay, that was a great win, and move on. Even if it was at 700, right? You paid 730. It's trading, you know, you're now up 730. That's a good time to ring the register. Okay. All right. So that's USO. And then the last one I want to look at regarding trying to short oil stocks or indexes using leaps is Halliburton. All right, so you can see that this has been going up quite a bit. It just hit its 12-month high just yesterday, and so it's dropped off that a little bit. It's down today, just like almost everything else, as you can see here. The energy is down, and the stock indexes are down. But everything is pretty much down today regarding oil. But I still think this is the early stages. Once again, that oil is potentially going a lot lower. This is their directional play. If you're wrong, get out if you're down 50%. So we're going to go over here for Halliburton, and we're going to look to do the 337 days here, and we're going to look to you can buy the 32 here for 475, which is not bad, and you can have the potential if it went. Once again, Halliburton is not going to zero, but if it did, then that's how much you would make. We know it's a very small, almost 0% chance it's going to go to zero. So you're not betting on that. You're betting on making the expected move, and the expected move in this case is just under $10. So if we went here and we bought, if we did a long dated put spread and we sold this one, if we sold this 22, that would make the cost about 350, as you can see here. And if we did this, then we'll pay 350 to basically make 650, so double almost, right? So this is the one I want to play. This is the one I'm going to send. You can also decide to go in the money a little bit, do something like that. That would be the same kind of a play. You got a little extrinsic because it's you bought the 35, it's trading at 33. So that's another way to play it, which is not bad at all. And that's actually probably a little better play to do. If you did something like this, you can pay 380 and to make basically pay one to make one over the next 337 days. All right, so I think it's going to be a pretty decent move down. So we're going to do this here, and we're going to buy, and we're going to put this in just a little because of the spread. We're going to see if we can get it for a little cheaper than what the mid is saying. Okay, so we're going to do this. We're going to put it in, and we're going to send that now, and we're going to let that sit for a second. And I'm going to count to 5 here. 1, 2, 3, 4, 5. That's not going to work. So we're going to go back and let's try to put it up at the 345. See if we can get filled there. And we're going to put it at 345. And we have not got filled at 345. So, but once again, if we're down 50%, we're going to get out of this. So we're not going to lose 347 if that's what we have to get filled at. So the mid is right now saying 345. But for demonstration purposes, we're not going to be able to wait. Normally, I would just wait and get filled at the price that I want to get filled at. Okay, so we're going to let that go to 347. So because I'm going to replace that here, and fortunately they're robbing us here. And 150, 151 or 351, still not getting it. And let's try, just gonna move this up just a little bit, 352. All right, so they gave us to us at 352. So you're gonna see here that we're already losing on the trade because of the, let's see if I'm looking at this correctly. Yeah, so we're already down $2. This is Halliburton right here. And we paid 352. The mid right now is going for 350. So we couldn't wait to be able to demonstrate this, but that's fine. So this is, but if this right here, this P&L open, everyone, if you're on the TastyWorks platform or Thinkorswim platform, the ones that we use, the Dorian Way, once this says 50% down, we're gonna get out. Okay, that's where we're gonna say, all right, well, that directional move didn't play. But we got a long time to see how this plays out. But if it falls a lot, let's say it falls 20%, 30 days from now, it's going to reflect. It's going to reflect significantly in this right away, and we're going to be able to probably get out a lot sooner than this 337. I'm expecting us to be out of this within the next 2 to 3 months, but we'll see how it plays out.